Hello there, welcome to Market Call. Chris Blumas is our guest today, Portfolio Manager at Raymond James Investment Counsel. And Chris will be taking your questions on North American large caps. There's that number, 1-855-326-6266. Or you can email us at marketcall@bnnbloomberg.ca. Chris, great to see you.
Great to see you too, Andy.
One point that you've been making is that inflation has yet to show up. We know that the tariffs and tangling of supply chains are probably going to lead to price increases.
Yeah, and I think that was a big, I guess, confirmation. Just even yesterday through the Fed meeting, you know, when they released their comments and they talked about it, they used even really, really aggressive language in terms of, you know, kind of what they were expecting. Mm-hmm. And so, you know, we're a few months in and, you know, we haven't seen any inflation yet, but, you know, it's in the pipeline. And, you know, from the different estimates that I've been reading, it looks like it could take anywhere from, you know, 12 to 18 months to be kind of fully reflected in the prices. And it is expected to be quite severe. So I think, you know, that, you know, when you preface that backdrop, you know, versus the, you know, Fed policy and the likelihood of, you know, some interest rate increases or decreases, I think that's, you know, front and center is inflation and unemployment.
So far, the market doesn't seem that worried in the sense that indices are pretty near record highs.
Yeah, they are. And I think that's the thing is what's happening is kind of the foreshadowing, kind of the slowdown in the economy. And really, you know, over time, you know, consumers and businesses were more dependent on kind of credit to drive economic growth. And more over time, it has been the stock market that has been a kind of a crucial factor in driving consumption. Mm-hmm. And, you know, despite the, you know, less than rosy economic backdrop, for markets to be where they are, you know, is a little bit surprising. Mm-hmm. But I think that's what people should keep in mind. Like, there is some potential for some downward volatility as well.
You're one of the type of companies you're looking out for is businesses that don't depend on the market for their financing.
Yeah, you know, just I think it's a good habit to focus on companies that can control their own destiny, you know, and then use that volatility that can come up in the market in your favor. And I think, you know, from time to time when markets are going to be very volatile, mm-hmm. you know, really good companies will sell off. And if you know what you want ahead of time, and you know, I tend to focus on companies, like I tend to be cash flow focused. So, you know, having companies that can generate good cash flow, that have strong balance sheets, they have a lot of options in tough markets. And when you think about how they come out of it, they come out of it quite strong, but they actually create a lot of value in down markets. And I think positioning yourself in those type of companies is really helpful longer term. And
we're going to get to some of Chris's ideas later on the show. He is our guest on A Market Call today. Chris Blumas of Raymond James Investment Counsel. The topic, North American large caps. Email us right now, marketcall@bnnbloomberg.ca, or there's that number, 1-855-326-6266. Let's kick off here with an email from Bert. Can I get your opinion on Laurentian Bank?
Yeah, so this is one, I think, Bert, this is one I would stay away from. I think, you know, typically you look at Laurentian Bank and the valuation is very low. And that would attract some people to consider it. What I think they don't have the scale, right? And they don't have the diversified offering of products that you get with, say, a Big Five or a Big Six bank. So I tend to focus my attention there. I think in terms of, you know, the technology investment that's required in banking, you know, the smaller banks, it's harder for them to make that investment. Mm-hmm. And then, you know, what that does is it limits the returns that they can generate. So instead of, say, something like a Laurentian Bank, I would focus on something like a TD or a bank in Nova Scotia, maybe a bank that's a little bit out of favor, has reasonable growth. And I think, you know, for most of the banks, like you're looking at them for income, right? The capital gain and the growth element is a little bit more muted just because the businesses are so mature. But I would look at the other two versus something like a Laurentian.
Let's head to Vancouver. Michelle, go ahead, please.
Hi, Andrew.
Hey.
I'd like Chris's opinion on Fairfax Financial. How does its diversified structure impact its long-term growth potential? Would you hold the stock long term, and do you like it compared to other companies such as Intact Financial or Berkshire Hathaway? Thank you.
Thank you very much.
Yeah, this is a great question. I mean, this is an absolutely wonderful company. So I think in terms of, it's not one that I own currently. I have owned it in the past, don't own it now. I think that the main issue why I don't own it is just valuation. As you can see from the 1 year chart, it's come up quite significantly.
I think it's near record highs, actually.
It is.
Yeah.
And so, that in itself, it still looks, by some metrics, it does look still that there's some undervaluation. This is P&C insurance is very, very defensive. So when people get a little bit panicky in the market, P&C is an area that people tend to run to, and then they bid up the prices. And so, this is one that's been kind of bid up in anticipation, just like Intact, just like Berkshire Hathaway. They've all been kind of bid up. So, these are ones where the valuations are just a little bit too rich for me. So, I think in terms of my ordering of them, I definitely like Fairfax the most of the group, with, Intact being second. I think Berkshire Hathaway, I would just leave that one, kind of going forward. I think it's just, it's been too inefficient as it's gotten bigger.
But Berkshire has?
It has, and I think it's, in terms of, the capital levers that they can pull, I would favor, some of the U.S. private equity names. Very, very similar business model, but a little bit more robust infrastructure in place. And so I think that, those would be the ones I'd look. But for both Intact and Fairfax, I would just wait and to add with a little bit more, valuation support.
Oh, okay. Until they're a little cheaper. In other words. Yeah. Okay. We've got Perry calling from Toronto. Go ahead, Perry.
Yes. Hi. Thank you for taking my call. I just wanted to know what happened to Enbridge and TC, that they're coming down and down and down every day. Thank you very much.
Thank you. Okay. Let's have a look at Enbridge.
Yeah, so this is, there could be some points that are similar to my last, a little bit of my commentary in the last question. A lot of these defensive, income-oriented names, they were places where people have run to recently. That's why the performance has been so good. I think in terms of Enbridge, the valuation is still very attractive. The dividend yield is quite strong. And I think the growth outlook for Enbridge is reasonable. So, for people looking for an income name, I think Enbridge is a very reasonable income name. Good valuation. And then you still want your income names to have a little bit of growth, and I think you do get that with Enbridge. So it is one I like, but it is, like to your point, they have sold off. So I would just kind of be ready and waiting. And I think, something below, $60 per share, I think is an attractive entry point, and that gives you, a price to distributable cash flow of around 10 times. I think that's very reasonable for a business like that.
And right now you're picking up a yield of about 6.1% on Enbridge. Not that shabby.
No.
Okay, I think we've got to take a break. Chris Blumas is our guest today, and Chris is taking your questions on North American large caps. We'll be right back. Let's head to Nizar in Scarborough. Go ahead, please. Not sure if we have Nizar. Okay, but until we get Nizar, what's your view on the big oil stocks right now? I know, it's such a hard call, but are you interested in the CNQ or the Suncor?
Yeah, I think those two are the ones that I follow quite closely. My preferred name in the space is CNQ.
Okay.
And, I have been watching and waiting for CNQ for quite a bit. And then, the valuations really kind of come up over the short term just with some of the geopolitical events that have unfolded around the world. So I think, CNQ's a great name. It just gushes cash, right? It's such an unbelievable generator of free cash flow. And they have that free cash flow kind of tied to their balance sheet and dividend policy. So it is a free cash flow that does benefit in shareholder returns because they will buy back shares, they will increase the dividend. in terms of them consolidating value for their shareholders, you've seen them do a number of opportunistic acquisitions as U.S. firms have left the oil sands. So it is one that I do like. I think it's my favorite in the space. But I think from a valuation perspective, I just wait.
You'd hold off for now.
I would.
Yeah, okay.
Yeah.
The yield on CNQ about 5.1%. Nizar in Scarborough, Ontario. Go ahead, please.
Oh, hi, Andrew. Hi, Chris. My question is on Manulife Financial.
Yeah.
The stock price has retreated to around $42 or so. Is this a buy here at 42? Because it could go up to, say, 45, 46. Your thoughts, please. Thanks for taking my call.
Thanks a lot.
Yeah, so I put this one, like Manulife and Great-West Life, the Canadian life insurance companies, they fall in the income bucket for me. So I don't think you'd want to be looking for this one as kind of a growth name, but for something that can give you, a really solid dividend yields. The dividend yields on both of them are north of 5%. So, you're going to get a pretty attractive dividend and you're going to get some earnings growth over time. And I think I don't have any issues with Manulife. I think in terms of its valuation is very reasonable, about 10 times earnings, very strong dividend yield. Where they differ from, say, somebody like Great-West Life is they're more Asia-focused. They're growing in Asia. So, that bodes well for them. And my favorite in the space is Great-West Life. A very similar valuation, but they're growing in mature markets in Europe. And I think, because of the structure of the European market, they're able to generate quite reasonable returns, and they're a very disciplined company. But I do like both of them, and I think the valuations are very reasonable. So, I think both of them would be buys here.
And those Great West, part of the Power Group, and of course, they tend to pay big dividends, almost 5% on Great West right now.
Yeah.
Thanks, Nazar, for the question. Here's an email from David, perhaps a rhetorical question. Is Corus a lost cause? We know this broadcaster has been struggling.
Yeah, it has. And I think, when you get to this point where they are at, I mean, it's fairly close to a penny stock. I don't know the exact price right now, but I remember when I looked before, it was less than a dime, right? So I think that's a really difficult situation. I don't think you'd want to get into anything like that because in the end, this is a company that's kind of teetering on the verge of kind of bankruptcy. And so in the end, when you get to this point, that's for specialty investors, those specialty distressed investors. How they tend to take advantage of this opportunity is they go in different tranches of the debt. And then when the company restructures or goes through, the bankruptcy process, that different structures of debt, the more subordinated stuff gets converted to equity, which means that the common equity holders get further diluted. So I think this is one, even because it has a low share price, like you see it there, 10 cents, that doesn't mean it could still have 100% in downside. So I think this is one I would just steer clear of.
Right. And Corus, of course, owner of Global TV, competes with CTV, our sister network. Okay, we have Anne calling from Scarborough, Ontario. Go ahead, please.
Excuse me. Hello, Chris. Your thoughts on Cameco going forward? I've done well so far. Should I add more? Thank you.
And if you don't mind me asking, have you been in Cameco for years, or did you recently get in?
Recently.
Oh, okay. Thank you. Thank you very much indeed.
Yeah, so this is a company. I don't own Cameco, but you look in that chart. That's quite a mountain that's there. And I think, in terms of kind of the nuclear resurgence, it's been so strong, and Cameco plays a key role. So I think if you have Cameco, I'd sit tight. Okay, and but if you don't own it, for viewers watching, if you don't own it, I would just kind of watch and wait on this one. There's so much hype in this space, and they cannot mine unlimited uranium. At some point, there's a certain amount of in uranium they can get out of the ground and they can sell, and their main assets in Saskatchewan are very, very, very high grade. So it's the best stuff you can get. The thing is, even to meet some of their sales contracts, they have to purchase uranium, on the secondary market. So I think, this is one where the macro thesis around uranium is quite strong. But in terms of Cameco, they'll definitely benefit from it, and they're executing very well. It's just, that price, it's hard for it to translate into their financials at a certain point because they're limited on the amount they can sell and the profit, the profitability of what they sell. So this is not one I would chase. So if you own it, sit tight. And if you don't own it, I would just watch this one.
Okay, we have an email from Monique. Could I get your comments on Copart? Would you buy it?
Yeah, this is a really good question because this is one I've talked on previous shows about, having a watch list of things that you're looking at. And for me, like Copart's been on my list for many years, and just recently it came down to values that I've been looking quite seriously at it. So I don't own it yet. It's within about 5% of my buy price. It's just such an exceptional company. So it's a technology company that helps insurance companies auction damaged cars. It's a global platform, but it's one that with their most recent quarter came under a bit of pressure. It was down about 10% on the release just because the growth wasn't as robust. I think longer term, this is a phenomenal business. They do things that these different insurance companies can't and don't want to do, and they do it very profitably. So I think it is one, like I said, I don't own it. I'm getting close on this one, and I do really like it. So I think, I would give you the same advice.
Okay. Can we get Chris's opinion? An email from Dana. Can we get Chris's opinion on UnitedHealth? It looks like it's bottomed for now. That stock's taken a hammering.
It is, and these are really, really tough situations because if you have a normal operating company that falls on hard times and there's some type of issue and you can do some analysis on it, when it happens to an insurance company, it is so difficult to figure out because, okay, were they under-reserved? Were they conservative on the reserving? You don't know what else is in there. And so this is one, when it did hit the skids, I definitely took a look at it. It historically has been quite a strong compounder, but, there's a lot of political pressure on kind of insurance reimbursement and insurance coverage. And then there's some uncertainty to know, okay, how pervasive has some of the problems been. And so I just feel like, looking from the outside, there's too much I don't know. So I would just steer clear of this one for now.
When we come back, we'll take a look at Chris's past picks. Let's get to the past picks. And Chris was on our show June 18th of last year. Main Street Equity was his first idea. Involved in multifamily housing, Chris?
Yeah, and so I think this is one, I think in the real estate space, this is just an absolutely exceptional compounder. They don't get much better than this. And part of the reason why it's been such a strong compounder, like this is Main Street Equity Corporation. It's not a REIT. It does not pay out the cash flow it generates. What they do is they retain that cash and then they continue to acquire kind of distressed assets. So very, very large inside ownership, very, very aligned interests, and they compete in a market that is very inefficient. It's the market they compete in is too small for mom and pop operators. But it's too small for the big REITs. They want bigger amount of units. So Main Street, competes in this really inefficient part of the market, and they do exceptionally well there. It's just this is one that you don't always get an opportunity to buy. So then when I was on last time, this is one that I've owned for a number of years, but I don't always get a chance to make it a buy. So I'm glad that it went through last year.
Visa, let's see how this one did. A nice gain. There was a bit of a wobble in the stock lately. Apparently, people worried about competition from these so-called stable coins, but certainly up in the past year.
It is, and I mean, Visa is just such a well-oiled machine. That network that they operate is the largest, and that gives them a little bit of an advantage on profitability. You see with the chart there's been a little bit of a dip lately. But, it generates such a massive amount of free cash flow. They have such a dominant position. And, the trend in towards digital payments is just accelerating and getting bigger and bigger. And so I think, Visa plays such a crucial role in that. So I think, this is one that I do own and still like very, very much.
Okay. And finally, Fortis, the utility company. Speaking of yield, let me check on how this one pays out. And would you buy this one again? Certainly a nice gain of almost 30% there.
Yeah, so even of the past picks, so the Main Street would be a buy today. The Visa wouldn't. It's a little bit above my buy price.
Okay.
And then in terms of Fortis, it would be a hold for me. It's just a little bit above. And, similar to some of the things I mentioned earlier where people ran towards defensive names, Fortis was front and center for that. Wonderfully well-run company, very well diversified. They have a reasonable growth platform, but I think it's just a little bit rich for me right now. So this is one that I still own on behalf of clients, but for people looking to come in, this is one that I would just wait for a little bit of a pullback.
Okay, and the yield on that one about 3.8%.
Yeah.
The utilities are interesting. Some of them have had a big boost lately over the speculation about the vast electricity demand for AI.
They have, and then they're going to have to deploy capital to capture that. And I think even with Canadian-centric income stocks, the utilities, the telecoms, the banks, in Canada, our economy is not as strong as the U.S. And so even there could be a point where the U.S. Federal Reserve has to raise rates. It could be more likely that the Canadian Central Bank lowers, which then provides, the competition between these income stocks and bond yields gets a little tighter, and that tends to drive more money into these. So you can still see a scenario where if the Bank of Canada were to cut rates, this year, that would attract more people back towards, some of those income names. So, the valuations in this case could still go higher.
Okay, we are going to take a break. We've got Chris Blumas on Market Call today. He's with Raymond James Investment Counsel, and he's taking your questions on North American large caps. We have a caller, Bally in Newmarket, Ontario. Go ahead, please.
Hey, hi, thanks. My question largely is around Celestica. What's the long and short run for Celestica? And I also want to understand, is there something they want to divest in one of their businesses? What is their strategy? What are the long and short guidance for Celestica? And is there another Celestica that we can own slightly at a better price?
Celestica.
Yeah, so this is one, even in the same bucket as the other semiconductor names. So, like NVIDIA, like Taiwan Semiconductor. And so, this is an area of the market that has seen massive demand. And that's largely been driven by AI and the build out of data centers. And so, Celestica had kind of morphed over time, and it supplies value added components to the semiconductor industry. So I think the outlook for Celestica is quite strong when you look at kind of the earnings growth expectations. And when you look at the valuation, it's quite reasonable. In terms of, it's not one that I do own. My preference in the space is Taiwan Semiconductor or NVIDIA. So Taiwan Semiconductor is the one I own on behalf of clients. And the reason why I kind of chose that one is over the longer term, everything kind of flows through Taiwan Semiconductor. They're the leading manufacturer of these high-end chips. So I think, no matter who's designing them, whether it's going to be, the big five kind of tech companies or it's going to be NVIDIA, it's going to flow through. The manufacturing is going to happen through Taiwan. So I think, there's more certainty on that. Who's the leading designer? Is NVIDIA now? Who knows about in 5 years from now? All of their customers want to get into designing their own chips. And so I think that's why, even in terms of Celestica, very, very well run, they're always looking to do acquisitions and build out their capabilities. But in terms of kind of the certainty of the future, my preference in this space is Taiwan versus Celestica, because I just think it's more essential longer term. And I think because it's Taiwan and there's the threat of, China and things like that, Taiwan Semiconductor will always trade at a very reasonable valuation. If you look at the multiple, sometimes it can get as high as 20, but right now it's around 15 times earnings. It's an essential company in the global economy today. I don't even think there is a more essential company in the world. It's the most essential company right now in the world, and it's at a very, very reasonable valuation. And they're diversifying their manufacturing footprint across mature markets in the U.S. and Europe. So it's one that I would prefer to Celestica. But, Celestica is done exceptionally well doing what they do. And I think that will likely continue. So it's not, the valuation isn't, you're not super offside on valuation, and it does have good growth. So if you do own it, I would continue to hold it.
Oh, okay. That's interesting how vulnerable the world is to Taiwan Semi.
Oh, yeah.
We've kind of that situation crept up on us. Jennifer in Sudbury, Ontario. Go ahead, please.
Hi, Chris. Thank you for taking my call. I'm a long-term investor, and I've been looking at an entry point to get in with the railways, either CP or CN. Do you think, in your opinion, that this would be a good entry point, and which one do you prefer? Thank you for taking my call.
Thanks very much.
Yeah, so I think in terms of those two names, they're really good businesses. They're essentially monopoly type businesses. Yeah, and so I do like those businesses, both of them. In terms of the timing, I wouldn't do either right now. When I talked a little bit earlier on the show about, inflation and tariffs showing up, that hasn't happened yet. It is going to happen. And then, as that causes economic problems, that these rails are so economically sensitive. And so I think, the North American economy is vulnerable right now, and so I think this is one you would just kind of want to watch and wait on. But I think in terms of my preference in the space, it's definitely CP. Their footprint now, including Mexico, is just so unique. And I think the growth profile, just because of their recent acquisition, they have a lot more upside on their earnings. And that gives them a little bit of a buffer with some economic weakness. So I think, they're both less than 20-time earnings right now. I think CP to me is just a more compelling business with its footprint. Plus it's got a phenomenal management team. So I think, CP would be the one. If you did want to buy it here, I think it's still an okay buy. I think you just have to be prepared to buy more if it were to get hit. And I think that might be a strategy you may want to deploy. If you're looking to invest a certain sum in it, you're not sure, there's a little bit of economic weakness, okay, you could buy half your position now. And then if it were to go, if there were to be some weakness, you could lower your average cost. But if things worked out well and we come out of it, at least you benefited from half your position.
We have Sal on the line from Toronto. Go ahead, Sal.
Hi there. Yeah, my question is on Pembina Pipelines. I was interested to know if now would be a good entry point for it, given that it's kind of stayed on the lower end of the valuation cycle over the past year compared to its peak, Enbridge, DC Energy. And if you could comment on whether Pembina is well placed from the gas side of things, or if it's just on the oil pipeline side. Thanks so much.
Thanks very much.
Yeah, I mean, there's a lot of moving parts there. I think in terms of Pembina, absolutely love this one. This is one that I do own for client portfolios. So have owned it for a number of years and have been very happy with it. Like I said, it's an income name, right? So, the main thing you're getting is a pretty strong dividend yield. And then you're looking for some earnings growth. And I think, Pembina and Enbridge give you that. There's different reasons why the different pipelines have performed. I think Pembina over the last year has probably been the worst performer of the group. TC's kind of restructured and kind of isolated the different parts of its business. Enbridge has continued to keep growing and done some acquisitions, and Pembina has done the same. What you have to keep in mind with Pembina versus, say, an Enbridge or a TransCanada is, Pembina does have some midstream infrastructure. So their assets are not as bulletproof as, say, somebody like an Enbridge. So I think Enbridge is always my first, choice. I think Pembina has, because it's not as big as Enbridge and because it has some different types of assets, it does have a better long-term growth outlook versus Enbridge. So I think, this is one that that if you do like it and you are looking for income, I think this is one that you definitely want to consider, and I would buy this one here.
Okay. We have an excuse me, an email from Fred. At what price would you start buying Constellation Software?
Yeah, this is a phenomenal compounder, and I've talked about this one a lot in the past. It is one that I own on behalf of in client portfolios for quite some time. It's a very, very unique business model. They're exceptionally good at compounding capital and doing things other people can't do. And really, if you said, okay, like what's their key thing that they do better than everyone else, it's the small deal. They do very, very small $2, $5, $10 million deals that private equity can't do. And they have, 6 operating subsidiaries that are essentially mini constellations that when Constellation rolls up the aggregate, it just keeps growing regardless of its size. But how they do that is because they have this capital allocation infrastructure for doing small deals. That said, it grows, at an exceptionally high rate, and it very rarely comes on sale. So, in terms of a buy price, I tend to look at this one kind of on an IRR basis, almost like if you were to do a private equity type acquisition. If you look at it on kind of a price to cash flow, like price to earnings, it always looks very, very high. I think price to cash flow, it always, somewhere around 30 times cash flow, that's around, a 3% cash flow yield, free cash flow yield. That's what I kind of use as my threshold. I think, they're about 2.5, 2.3 right now. So it's above my buy price. So it's not one that I would buy right now, but I would look to buy this one definitely on a pullback and then hold it for a very long time.
Okay. We're going to be back with Chris Blumas. Chris is taking your questions on North American large caps. Kim is standing by in Leamington, Ontario, tomato country. Go ahead, Kim, please.
Hey, Andy. Chris, thanks for taking my call. Hey, I was in the penalty box for quite a while. It
TD Bank.
Like it's
okay.
Yeah, it looks like it's come out, and just wondering, do you feel like it's gonna? Is the past behind it, and is it gonna keep going up, or what do you feel like for a long-term hold? Is it good to buy right now still, or what do you think compared to the other banks? Thanks for taking my call.
Thanks very much.
Yeah, thank you. I think this is a great question, and I think this highlights like a massively important point. And if you look at the charts that are getting put up right now, and you look at the share price performance in 2025, when these big companies, they're high index components, when they trip and fall and they do a face plant, they get massacred. Everybody jumps on the hate train, and all you hear about TD is negative, negative, negative. And if you look at what that stock has done in 2025, from that point of peak negativity, it's probably up 25%. So I think that's where, even as investors sitting at home, sometimes you just have to, don't buy into, you just can't buy into the kind of the hate fest on certain companies, because I recommended this one, people were really unhappy, and then look what it's done. And I think when I come on the show and I talk about, you get something that can have earnings growth and multiple expansion, the biggest source of return in any investment you buy is going to be the change in that multiple. Because you can get a business that grows really well, the market's unhappy with it and cuts the multiple in half, it's going to be a loser. Right. But you get a business that can grow reasonably well, and in this case, TD, it still can grow at a low single-digit rate, And then the multiple re-rated. Instead of it being 9 times earnings, now it's 11.5. And so that multiple re-rating is the entire reason for that stock going up this year. So, it is one that I own on behalf of clients. It's slightly above my buy price today. I think they've done an excellent job kind of right-sizing the ship. And when you're analyzing, okay, their likelihood of a successful turnaround, they had excess capital. That prevents them from doing an equity raise. There were so many positives that basically they just have to ride out the wave of negative sentiment. And I think this one is one longer term that will do reasonably well. It's for people who are looking for income. You can get a little bit of earnings growth. And I think the big $1 million question for TD longer term will be, do they stay in the U.S. or not? Because it's very, very unlikely that they're going to commit additional capital to build out that platform in the U.S. And if you look at the platform they've built out over the last decade, it's somewhere north of $16 billion that they spent. And they bought branch networks that were more higher cost branch networks. That model doesn't work in today's environment. And their business is, the returns on equity are mid-single digits. At some point, you have to say, okay, we're either going to dispose of this. It's a valuation, the valuation of the U.S. business is not reflected in the share price. It's a freebie. It's a free option. If they can, get some value from this, either from selling or building it out, I think building it out's off the cards, right? Like they didn't do that well. And so I think, over time, over the years, there'll be a disposition of this U.S. business that will provide them some more capital that will allow them to keep increasing the dividend, buying back shares, and building out things at home. So I think it is one that I do like, and I think it is one that I'd be willing to own. I just wait for a small pullback here.
Let's head to Mississauga, Ontario. Frank is on the line. Frank, go ahead, please.
Hi, thanks, Andy, for taking my call. And Chris, building on your last feedback on TD, sentiment change and multiple expansion, when do you think Algonquin is going to go through that phase? I think it has gone through it's created a solid base, I think, and it's turning around. Do you think it's a hold for next 3-4 years, and it can get back some decent returns? And also, if I may add to a CN and CP story, I think Canada is now expanding its horizons, and I see a lot of product coming from Europe.
I think we lost him there. The audio was deteriorating. Sorry about that. But thanks very much for the question, Frank. Algonquin Power.
Yeah, so this is one, this is one kind of a bit of a fallen angel type story with Algonquin Power. It's a company that had done exceptionally well under the prior management team, maybe 2 management teams ago, kind of buying unique assets and building, a strong cash flow profile. And, then Algonquin got into some trouble because they were a bit overextended. They kind of separated the different businesses, and they're kind of a going concern going forward. When you look at it, it always looks cheap. You look at a price multiple or a free cash flow multiple, it looks very cheap, and that attracts a lot of people. And I think if you know how it's been built, the one argument always is, some bigger company will look at the multiple and acquire them. But the thing is, if you know how it was built, it's built by a lot of kind of unique assets that are spread out around the U.S. The thing is that type of a footprint, it's not a consolidated footprint in a certain key market. So it's probably less attractive to a larger company as an acquisition target. So I think if you're holding your hat on that there's going to be a distressed buyer, I'm not sure on that one. And then you think of okay, their longer term path to turning it around and getting market sentiment in their favor. How they would do that is by accelerating growth somehow. And I think they're still slightly capital constrained and can't do that. So I think this is one that is going to be kind of range bound for quite a while. So anytime you get an opportunity to there's a positive quarterly release and the stock pops like you did on the last one, I would look at that as just to exit. I would look to, if you're down, which a lot of people are, look at some of the positive news just to roll out and to look for something else, because I think the upside is limited for those reasons that I mentioned.
Okay, so cool there on Algonquin Power.
Yeah.
Thanks for the question. Let's head, I think it's to Burnaby. Yep, Burnaby, BC. Debbie, go ahead, please.
Hi, good morning. I own some Rogers Communication. I just purchased it, and I'd like your opinion on Rogers, please. Thank you.
Thanks.
Yeah, so I think the whole telecom space has faced its share of challenges, and it doesn't matter what player you are in, any of the large players have been hit really hard, and that's partly to do with increased competition.
Mm-hmm.
The flip side is that all of them, they don't have an outlet to grow kind of outside of Canada. And so when you're looking at owning one of these, it's typically for the income. Mm-hmm. And so, in terms of, I think in terms of if I were to rank, kind of the operators, I think TELUS is the best operator. Rogers has a very unique position because they just bought Shaw and they have, some of those assets that give them an edge on the cost-cutting side. But I think in terms of this whole space right now, I would just steer clear of it. You don't have, even with an income stock, you do want some growth because even if it's a small amount of growth that you could get, that helps offset the valuation risk elsewhere in the business. And so I think, all of these companies, all the telecom names in Canada are very, very inexpensive, but they're growth challenged and profitability looks like it's going to be flat for quite some time. So I think the only attraction there is just the income. Mm-hmm. In the case of Rogers, it's the lowest dividend yield of the group. So, maybe look elsewhere there.
Don't go away. Chris is going to be sharing his top picks after the break. First idea, Descartes Systems.
Yeah, so this is a software company, and their specialty is, supply chain management and logistics. Really, really unique company, very, very well run, exceptionally strong balance sheet. And this is one that, has always traded, it trades currently at a fairly rich valuation, but it typically trades at a much richer valuation. And, with the trade uncertainty and with the Trump tariffs, this is a name that has got hit. And so this is, maybe could be around this year to date, down around 20%. So, in terms of looking at the shopping list, this is one, I've wanted to own for years, on that short-term weakness, did take advantage of that opportunity to buy. Mm-hmm. It's still below my buy price today. So it is a name that I think will do very, very well long-term. And the valuation is attractive right now.
Right. And I'm showing it down about 17% this year.
Yeah.
Okay, your next idea, Alphabet.
Yeah, and I think this is one really more kind of on the tech side, but just a lot of hidden value. There's so much negativity around Alphabet surrounding its antitrust case, but then also too with AI and the impact that it may have on search. And I think in terms of outlets for online advertising, you have. It's just such a premier destination for online advertising. So I think in terms of, the business fundamentals, still very, very strong. The business is generating a ton of cash. And they also have, some unique AI capabilities that they've had rolled out. And so you've seen no loss in search market share. And if you look at the balance sheet and you look at some of their other operating subsidiaries, this is a business just on the headline, like the earnings numbers, about 20 times earnings. That doesn't include the excess cash on the balance sheet, and it doesn't include, any of their other, their cloud services business or any of their other operating subsidiaries that collectively they're generating negative operating earnings right now. So I think, longer term, whatever happens, if the business is forced to be broken up, there's a lot of hidden value that will get harnessed. Mm-hmm. And I think it's just such a unique business, and there's just so much hidden value there. That's one that it's a strong buy today.
Strong buy. And then finally, Brookfield Infrastructure, BIP.UN in Toronto.
Yeah, so this is one, I always like to have one for income investors. I know we talked a lot about income names during the show. This is probably my top income name right now. Very, very inexpensive valuation, less than 10 times FFO, very, very strong dividend yield. And you've got a global platform and you've got a diversified infrastructure footprint. They've got so many different asset classes they can allocate money to around the world. And I think this is one where it gives you, the opportunity for significant earnings growth over the medium term and the opportunity for significant multiple expansion. And I'm not sure why it trades at such a low valuation. It could be because, deals have been a bit sluggish, but you've even seen deal activity start to pick up. So I think this is one, cash flow is great, the dividend yield is good, and the valuation overall is quite strong. So it's one for the people looking for income. I think Brookfield Infrastructure is a really good pick.
And they're getting in on the demand for next generation broadband infrastructure, apparently. They just bought an outfit called Hotwire Communications, so that they're getting into data as well.
Yeah, they're everywhere, and it's so unique. They've got rail and storage infrastructure, they've got utility infrastructure, they've got data, they've got energy, midstream infrastructure. So the thing is, like, wherever they see opportunities in those asset classes and around the world, they can buy and sell things to create value for you. And so, when you look at other utility companies that may be just a little bit more Canadian centric, or they're in one of those, sectors. Here you've got somebody in 4 really attractive sectors, and then you've got, a global footprint. So that gives them the edge on allocating capital and buying and selling. And so I think that gives you quite a unique. It gives you the opportunity to buy this and hold it for a really, really long time.
Thanks very much, Chris.
Thank you, Andy.
Chris Blumas has been our guest. Thanks very much indeed for watching Market Call.